Good morning and thank you for your time. This presentation reviews Yope beverages with focus on capital decisions, financing options, and resilience. I will recover the earlier positions shown how WACC, option pricing, and sensitivity testing shape choices, review financing and risk, and finish with ethical recommendations for balance sheet control. Yope Beverages position and enhancement. Yope makes non-alcoholic drinks in a market under health pressure on sugar. Company leaders have asked if the structure can fund reform, absorb shocks, and hold value. In my previous report, I found strong profit and weak structure. Debt high, cash thin, and payout heavy. I set 3 moves: cut payout, rebalance debt, set WACC guardrails, retain earnings to lift cash. I also set a cash floor of 60 days and clear board rules on cover and net debt. I kept lender talks open and kept equity on the table. Today I add benchmarking, stress tests, and apply WACC trend to screens. WACC trend and funding implications. From 2015 to 2019, WACC fell from 6.18% to 3.48%. For comparison, global beverage peers are typically reported in the 5 to 7% range, highlighting that Yope's cost of capital is unusually low. Yope's lower cost of capital suggests greater room for funding, but also reflects higher leverage risk in the capital base. That cut in the blended capital rate lifts project value and widens funding room. A lower WACC lifts MPV and lowers the hurdle for green lights. It also makes debt look cheaper than fresh equity, all else equal. I use this trend to rank choices: reprice the debt, stack first, retire cost lines, term out at lower fixed rates, and keep gearing inside board limits. Then test planned spend. Any project must clear WACC by a safe spread. If it only scrapes in, hold or redesigns. Applying WACC to funding and projects. Set 3 rules. 1. Set the live hurdle as WACC plus a safety spread. For example, 2 points. 2. Run DCF at base WACC and at WACC plus 1 and plus 2. Keep only plans that hold value across those cases. 3. Match funding to asset life. Use long-term debt for plant and brand, short-term lines for working capital. With WACC this low, retained profit remains first, then debt, then equity if needed. This keeps control, lowers total capital costs, and guards cash. Report WACC, the spread, and pass or fail for every plan each quarter. Call price fundamentals. The call price measures the value of a right, not an obligation, to buy shares at a set strike price. For Yope, the spot price is $61.67. The strike is $50. Expiry is 24 days. Volatility is 26%. The risk-free rate is 0.01%, and the dividend yield is 10%. Applying the Black-Scholes formula gives a call price of $11.27 per share. This is the premium investors would pay today for the right to participate in the potential upside above the strike. Option value drivers. This result signals how the market prices growth and risk. Because the option is already deep in the money, the premium is high. It reflects both the distance between the current share price and the strike, and how volatility and dividends shape value. Volatility increases potential upside, pushing the price higher, while dividends reduce future share value, pulling it down. Together, these inputs explain why the call price sits at this level and why investors value the equity so strongly. Implications for financing. For financing, three insights matter. First, the strong option value confirms that equity is attractive to the market, but any new issue risks dilution. Second, the premium shows lenders will recognize equity investors expect growth and may raise their required return on debt. Third, internal cash remains the lowest cost funding option, free from dilution or added interest. The board should treat the Black-Scholes output as a market signal, not an instruction. It frames the trade-off between equity, debt, and retained earnings. Importance of sensitivity analysis. Sensitivity analysis is a practical way to test how outcomes change when the underlying assumptions shift. For Yope, the key variables include revenue, growth, product mix, sugar regulation, interest rates, and raw material costs. By flexing one input at a time, the business can see which factors drive the greatest change in value. This matters because forecasts built on single numbers can create false certainty. A model may look sound at base case, but a small move in sales or costs can erode returns. Sensitivity testing replaces guesswork with evidence. It shows decision makers how fragile or how resilient cash flow, profit, and capital ratios really are. Sensitivity analysis for yolk beverages. For yolk, sensitivity analysis should sit alongside every major capital and financing decision. Test downside cases such as a 10% revenue fall from sugar reform, a 200 basis point rise in funding costs, or a 15% increase in raw material prices. Compare each case against WACC plus a safety margin. Projects that still add value under these shocks are strong candidates. Projects that fail must be reworked before approval. Running these tests build clarity for executives less familiar with finance, because the results are expressed by simply what holds, what breaks, and where to act. This converts uncertainty to visible, manageable risk. Short-term financing options. Short-term financing provides flexibility to cover daily operations, working capital gaps, and unexpected shocks. Yoke can extend trade credits with suppliers, use overdraft facilities, or arrange short-term bank loans. Commercial paper could also be considered if credit ratings allow. These options are fast to access and match the short life of current liabilities, but they create a rollover risk. Heavy use forces constant refinancing and exposes the business to sudden change in interest rates or credit supply. For Yoke, with a current ratio below 1, short-term finance can stabilize liquidity, but it must be tightly managed and linked directly to receivables and payables. Long-term financing options. Long-term financing underpins strategic projects such as new product development, market investment, or plant upgrades. Options include corporate bonds, syndicated bank loans, equity raising, and higher retention of profits. Bonds and loans spread repayments over years, easing cash strain but lifting financial leverage. Equity avoids repayment pressure and stabilizes solvency, yet risk dilution of existing shareholders. Retained profits is the cheapest form of capital, though only available if dividends are reduced. For Yope, long-term stability depends on cutting the payout ratio, refinancing existing debt into longer fixed tranches, and keeping equity as last resort unless market conditions shift. Yope's payout ratio sits at 69%. This over-distribution limit retains earnings and explains why peers in the sector often rely more on internal cash to fund growth. Key short-term risks. Short-term financing creates exposure to liquidity and refinancing risks. Yope's current ratio under 1 highlights vulnerability, and any delay in receivables or jump in input costs can trigger stress with payables. Heavy use of overdrafts or rolling short-term loans force constant renewal, raising dependence on bank and exposing the firm to rate hikes or credit withdrawal. Operational shocks compound the risk. A sudden change in sugar regulation or supply disruption could cut sales or lift costs overnight. With limited reserves, even minor shocks could restrict flexibility. To reduce exposure, Yope should link short-term borrowing strictly to working capital cycles and enforce a 60-day cash for. Key long-term risks. Long-term financing carries structural risks. Rising interest rates or widening credit spreads lift Yope's debt costs and increase WACC, which reduces the value of past and future investments. With gearing above 250%, solvency risks is elevated. In contrast, listed beverage peers average debt to equity closer to 100 to 150%. Yope's level more than doubles that range, which magnifies refinancing and covenant pressure. This gap explains why lenders may demand tighter covenants or higher spreads, and why investors may view new equity as distress signals if poorly timed. Issuing equity reduces leverage, but risks dilution. Strategic risks also weigh heavily, as slower demand growth driven by health campaigns could erode returns on reformulation projects and brand investments. To limit exposure, Yope should refinance into long-dated fixed tranches, cut reliance on floating debt, and track leverage and coverage ratios quarterly. Ethical issues in financing. Ethical financing means balancing shareholder returns with responsibility to employees, suppliers, and the wider community. Yope's current practice of paying out almost 70% of earnings prioritizes investors but limits reinvestment. An ethical stance calls for a more balanced split, rewarding owners but also retaining enough to protect jobs, fund reformulation, and maintain resilience. Transparency is another key issue. Lenders, investors, and regulators must receive clear disclosure on leverage, covenants, and capital allocation. Concealing risk damages trust. Ethical financing also means avoiding debt strategies that transfer risk to suppliers or staff through delayed payments or cost cutting that harms safety and quality. Embedding ethics into decisions. To end ethics, financing choices must pass both financial and social screens. First, capital raise should support long-term value creation, not short-term share price lifts. Second, debt levels should remain within bounds that avoid distress scenarios that could trigger job losses or squeeze small suppliers. Third, equity raising must be timed and communicated openly, ensuring investors understand the rationale. Finally, sustainability must guide decisions allocating capital to healthier product reformulation, not just distribution expansion, which strengthens both brand and society. For Yoke, building this ethical lens into broad policy signals integrity, reduces reputational risk, and aligns financial health with community expectations. Core recommendations. The review confirms that strong profitability is undermined by weak structure. The first priority is to reduce the dividend payout to align with sustainable cash flow. Retained earnings should then be used to strengthen liquidity and pay down floating rate debt. Refinancing into fixed long-dated tranches will cut volatility. Every capital project must clear WACC plus a safety spread, and sensitivity testing should be embedded into approvals. These steps create a safer balance sheet and protect long-term value. Strategic outlook. Management should present this capital discipline to lenders and investors as a proactive risk control. A clear policy on WACC, gearing limits, liquidity floors, and dividend rules will build credibility. Ethical principles must shape every financing choice, balancing shareholder rewards with reinvestment, transparency, and sustainability. By acting now, Yoke secures the flexibility to reformulate products, absorb shocks, and pursue growth opportunities. Profit backed by resilience will allow the business to keep control of its future rather than react under pressure. Let me close with the big picture. The goal is a strong balance sheet that gives management control of the future, not creditors. 4 actions achieve this: cut payouts, refinance with WACC guardrails, embed sensitivity testing, and ensure ethical financing. Together, these align profit with resilience and keep Yoke ready to grow.